Welcome, dear traders. Today, stocks are trading flat as investors are anticipating the inflation report. Demand for the risk assets remains subdued. Consumer prices are likely to increase. If so, the Fed may switch to more aggressive tightening. Nevertheless, the minutes published on Wednesday contained a hint of a downshift in the pace of a monetary tightening. Several policymakers said it would be important to calibrate the pace of further rate hikes to reduce the risk of significant adverse effects on the economy. However, the majority of Fed officials are convinced that premature easing may cause more harm to the economy compared to the consequences of aggressive tightening. The overall tone of the minutes is certainly hawkish. Several policymakers also noted that the historical record cautions strongly against premature losing, as it carried certain risks as well. Is there a likelihood of a monetary easing after the release of inflation data? Most traders doubt it. According to the CME FedWatch Tool, the chance of another 75 basis point rate hike in November totals 80%. At the start of the week, this indicator was slightly lower at 77.6%, and yesterday, after the publication of minutes, it rose to 90%. In the Asian session, the US dollar index advanced above 113.30 ahead of the long-awaited inflation report. It's trading near its 20-year high amid expectations of new aggressive rate hikes. Demand for the US dollar as a safe haven currency also remains consistently high. On top of that, US Treasury Secretary Janet Yellen noted that the US economy remains resilient in the face of global economic headwinds. This is why the US dollar is highly likely to stay the strongest currency in the basket. Today, it's consolidating in the sideways channel of 113.08 and 113.45. Its growth is facilitated by an increase in the US government bond yields and expectations of inflation data. The yen also rose slightly thanks to the Bank of Japan verbal intervention. We cannot tolerate excessive volatility in the currency market driven by speculative moves, Finance Minister Shunichi Suzuki pinpointed. It's not as if we have a specific level in mind. Instead, we are looking at volatility. So the last intervention occurred mainly because of currency speculation. If the regulator sees the signs of speculative moves again, it will not hesitate to intervene. Currently, there are no such prerequisites. According to surveys, about 75% of Japanese firms cannot compensate for the yen's drop beyond 145 per dollar. Analysts assume that Japan has about $120 and $130 billion for interventions. If the central bank undertakes another $20 billion intervention, as it did on September 22, it will have enough money only for 5 or 6 interventions. The effect of the last intervention has long gone. The dollar-yen pair broke above 146. The regulator has made no comments so far. In the Asian session, the pair managed to enter the range of 146.64 and 146.93, settling at 146.84 amid the consolidation of the US dollar and the verbal intervention. As for the further resistance level, the yen is now hovering near the low of August 1998. In the times of the Asian financial crisis, the Japanese currency depreciated to 147.64. The Aussie is down due to a cornucopia of negative fundamental factors. The risk sentiment decreased. Concerns of a global recession and the worsening epidemiological situation in China are also weighing on the Australian dollar. As a commodity currency, it's losing steam amid falling oil prices and the declining demand for Australian ore from China's producers. The Aussie was volatile in the Asian session. It moved moving up or down. It was trading at 0.6273 near yesterday's closing price of 0.6276. If inflation figures turned out to be higher than expected, it will be extremely bearish for risk assets and commodity currencies. The AUD-USD may slide into the downward range of 0.6236 and 0.6298, ending the week with big losses. InstaForex TV team makes relevant video reviews every day so that you can open only profitable trades. We remind you that today the US Consumer Price Index is in the limelight. This report will provide more clues about the Fed's key rate decision at the November meeting. And that's all for now. Stay tuned and keep close tabs on the market developments. See you soon.